Now, Abhay, because I was reading your newsletter and because you mentioned out there, right, that some of the pockets in the markets are now even beyond frothy. In fact, I was looking at one of the charts tweeted out by a fund manager, which showed that the P multiple, aggregate P multiple of the top 500 stocks and what percentage of stocks are trading above 50 times P multiple. 50%, more than 50% of the stocks are trading at a P multiple greater than 50, which makes the market very expensive. So Abhay Agarwal, my question to you is, how are you building out your portfolio as aggregate currently? What kind of stocks are you choosing? And are you sitting on cash or are you fully deployed?
Niraj, we are being very defensive. Again, let me put a disclaimer here. We are very, very bullish as anybody who believes in the India's long-term growth thesis. If you take a 5-year call, if you take a 10-year call, I don't think any market in the world will create the kind of returns that India would make for long-term investors. Having said that, there are times when the markets get overvalued. There are times when markets are undervalued, and that's the cycle that the markets go through. And as the data you put out, Niraj, and I think you and I and the fund manager are one of the few people who's actually looking at P multiples. Right now, everybody is chasing short-term performance. But what we are doing at our portfolio level is that we are just being more defensive. And to become defensive, what we have done is, first of all, we have looked at the portfolio level valuation. And at a portfolio level valuation, we want to be below 25 times P multiple. Because if the market's correct, the expensive stocks are correct the most first. So we have made some changes to the portfolio, taken out some stocks in the portfolio that we like. The companies we like, we'll probably add them back at the right time. But they were trading at a multiple of more than 100 times, which we find it difficult to justify in a slow growth environment. Secondly, we have increased cash in the portfolio to about 20%. This is a temporary call. It's not, when we find opportunities, we'll definitely deploy. Third, we have increased the weight of large caps just because, the large caps that are not the expensive large caps, but are still growth stocks available at an attractive valuation for the growth that they're getting into, so Hindalco, Grasim, these kind of companies. So these are the three things we have done, Niraj. The returns have been very robust over the last couple of years. So we just want to protect those returns right now. I think the next 3 to 6 months will be very choppy for markets globally. A lot of trigger events, rate cuts, election results. Even in India, there are 3 states that will go through elections. So I think we just want to wait it out, and we have a buy list ready. We will use the cash in the portfolio, as we get opportunities.
Okay, so defensive portfolio, a bit of cash. We'll use the cash when the opportunity arises. That's the summation of the portfolio construct. I have a question, about 2 questions before we wrap up. One, that I don't see an IT service name in the portfolio. And please correct me if I'm wrong. Why is that the case? We are closer to November. There's a lot of talk of how post-November there might be clarity. We are closer to a rate cut cycle. Usually that's augured well for the tech businesses too. Why no IT service stocks?
We have been underweight on IT for last 1.5 years. From January last year, we don't have any IT stock in the portfolio. The reason for that, for the IT services exporters, Niraj, is that when the management itself is guiding for 1 or 2% or 3% growth over the next year, I don't know why we should pay a multiple of 25 to 30 times or even more just because of the optical defensive-ness of earnings. I mean, investors get rewarded for betting on growth and taking that risk. But if the management itself is guiding for a flat to no growth, I don't want to second guess the management and say this company will actually grow faster. So one is from the valuation perspective. The second is from the perspective of the market dynamics and the product offerings. I think a lot of these companies are right now under pressure from newer technologies, especially AI, ML, that is taking away large parts of the fixed cost projects that they do. The whole dynamics of pricing is changing even with large customers. And if you look at their large banking financial services customers, JP Morgan, Wells Fargo, Citibank, they have their own cost pressure. So it's not that if the rate cuts happen, the banks start spending a lot of money and all these contracts will come to the companies. There is going to be a lot of pricing pressure, lesser, very large value deals. Even large value deals will have lower margins. So I think in that environment, I don't see why we should jump in and add an IT services company to our portfolio. We are looking at IT product companies, which we find to be interesting in case they are focused on a particular vertical or focused on a particular new technology. We are considering them, so maybe we'll add them to the portfolio, but definitely staying away from large cap IT names right now.